The soybean may seem small, almost unremarkable at first glance, a humble seed with a simple appearance. But in reality, it's a giant in global agriculture and trade, playing a pivotal role in the economic relationship between the US and China, two of the world's most powerful nations. Across the heartland of America, vast fields stretch for miles, producing millions of tons of soybeans each year. These crops are not just a staple for local communities. They are a cornerstone of US exports, supporting rural economies and providing livelihoods for countless farmers and workers. Once shipped overseas, American soybeans arrive in China, where they are transformed in bustling factories. Here, the beans are crushed to extract oil for cooking and processed into soy meal, a critical ingredient for animal feed that supports the world's largest pork industry and a rapidly growing demand for protein. As China's appetite for meat has soared, so too has its dependence on imported soy meal. This reliance makes US soybeans not just a commodity, but a vital link in ensuring food security for hundreds of millions of people in China. This deep interdependence has turned soybeans into a barometer of US-China relations. When trade flows smoothly, soybeans move freely across oceans. But when political tensions flare, both nations feel the impact, and the global market is thrown into uncertainty. The journey of soybeans from American farms to Chinese tables is more than just a supply chain. It's a story of economics, diplomacy, and the complex ties that bind two superpowers together, shaping the lives of farmers, workers, and consumers on both sides of the Pacific. Today, that relationship faces one of its biggest challenges yet. The outcome will have major implications not only for the US and China, but for the future of global trade and food security around the world. After a high-profile meeting between US and Chinese leaders, American farmers were promised a lifeline. China would buy 12 million tons of US soybeans by the end of 2025, a figure that seemed almost too good to be true for an industry battered by years of uncertainty. The agreement was hailed as a breakthrough, a sign that the world's two largest economies could find common ground, at least in agriculture. The deal also included a commitment for China to purchase 25 million tons annually for 3 consecutive years, a volume that would have a massive impact on US exports and rural communities. The announcement brought a wave of hope to farmers across the Midwest, many of whom had faced plummeting prices and shrinking markets due to the ongoing trade war. As harvest season approached, the promise of renewed demand from China offered a glimmer of stability and a chance to recover from recent losses. But while US officials touted the deal in press conferences and public statements, China remained notably silent, never officially confirming the ambitious purchase numbers. This silence raised eyebrows among analysts and farmers alike. Beijing did suspend tariffs on US soybeans, a move that was supposed to open the floodgates for trade. Yet, the expected surge in orders never materialized. Only a trickle of shipments left American ports, far below the promised volumes. The gap between political promises and market reality has left many in the agricultural sector questioning what's really happening behind closed doors. Farmers, already wary from past disappointments, are left to wonder if the deal was more about headlines than actual change. China's main state-owned buyer, COFCO, has so far only booked a handful of small cargoes for late 2025 and early 2026, a far cry from the massive purchases that were promised. This cautious approach suggests that, despite the political gestures and public agreements, China's economic realities and domestic needs may not be fully aligned with America's export hopes. Trade experts point to shifting demand, stockpiles, and global competition as factors complicating the picture. The market is left waiting, caught in a state of uncertainty, as traders and farmers alike wonder if the promised purchases will ever materialize or if they were simply diplomatic theater. For now, optimism has faded, replaced by skepticism and a growing sense that the future of US-China agricultural trade remains as unpredictable as ever. The real obstacle to US soybean sales isn't just politics, it's China's massive oversupply, a situation that's reached historic proportions and is now reshaping global trade flows. After months of record-breaking imports from Brazil, Chinese ports are now overflowing. In November 2025, inventories soared to an unprecedented 10.3 million tons, the highest level ever recorded in the country's history. That's a staggering 3.6 million tons more than last year, creating a logistical nightmare for port authorities and traders alike. Warehouses are packed to the brim, and the sheer volume of soybeans is stalling new imports, causing delays and bottlenecks throughout the supply chain. Chinese processors, known as crushers, are also feeling the pressure. They're now sitting on 7.5 million tons of soybeans, their highest stockpile since 2017. Many facilities are operating at or near full capacity, struggling to keep up with the relentless inflow. The entire supply chain is saturated. Beans are piling up faster than they can be processed or sold, leading to long lines of trucks at ports and warehouses turning away new deliveries. The system is stretched to its limits. This glut is the result of China's strategic pivot to Brazil during the height of trade tensions with the U.S. Brazilian farmers seized the opportunity, ramping up production and exports to fill the gap left by American suppliers. Even after a trade truce was reached, Chinese buyers had already committed to massive orders from Brazil, locking in contracts months in advance to secure their supply and hedge against future uncertainty. For December 2025 alone, about 2 million tons of soybeans are already booked for delivery, most of it coming from South America. These shipments will only add to the existing surplus. With so much supply already in the pipeline and storage facilities bursting at the seams, there's little room for new U.S. orders anytime soon. Until this mountain of soybeans is worked through, American farmers will have to wait for their turn in the Chinese market. China's soybean processors are facing another problem. They're losing money. Negative crush margins, where processing costs exceed product prices, have plagued the industry since mid-2025. In hubs like Rizhao, losses are around 190 yuan per ton, and recovery isn't expected until at least March 2026. Soy meal prices have plunged over 20% since April, now hovering near 3,000 yuan per ton, due to oversupply and weak demand from the animal feed sector. This creates a vicious cycle. Too many beans lead to cheap soy meal, which means losses for processors, who then stop buying more beans. Market fundamentals are overriding political deals. Until processors see profits, they won't buy more soybeans, especially expensive U.S. ones. The result? Stockpiles keep growing, and U.S. export hopes remain on hold. Economics, not politics, is calling the shots. China's soybean surplus isn't just at the ports. State reserves hold an estimated 40 to 45 million tons. That's double what China imported from the U.S. last year, enough to cover 5 months of demand without a single new shipment. This massive cushion gives Beijing leverage and removes any urgency to buy more, regardless of trade agreements. The promised 12 million tons for 2025 is just a fraction of what's already in storage. Adding more would only worsen the glut and depress prices further. China's buying decisions are driven by domestic needs and market economics, not just political commitments. The numbers show China can afford to wait for better market conditions. For U.S. farmers, that means more waiting and more uncertainty. The reality of China's reserves overshadows any trade deal. Even if China needed more soybeans, U.S. beans face another hurdle: price. Brazilian soybeans are simply cheaper, about $480 per ton for January 2026 delivery, compared to $540–550 for U.S. beans. That $60–70 per ton gap means a buyer saves over $4 million on a standard shipment by choosing Brazil. Factors like currency devaluation, bumper crops, and shipping costs all favor Brazil. Even with tariffs suspended, U.S. beans remain more expensive, erasing any competitive edge. For Chinese buyers, especially private crushers, the choice is obvious. Buy the cheaper, high-quality Brazilian beans. State-owned firms may make some token U.S. purchases for political reasons, but volumes will be limited. Price, not politics, is driving the market. Until U.S. beans are competitive, China will keep looking south. Market experts agree, don't expect a surge in Chinese buying of U.S. soybeans anytime soon. Huge stockpiles, unprofitable processors, and cheaper Brazilian beans have created a perfect storm keeping China on the sidelines. State-owned firms may wait for crushing margins to recover before making big purchases. Any significant buying could be delayed until well into 2026, when market conditions might improve. Small purchases so far are seen as token gestures, not the start of a buying spree. The domestic market is saturated, and any new U.S. beans would have to displace cheaper Brazilian ones. The consensus: a major return of Chinese demand is a matter of when, not if. But that when is not now. For U.S. farmers, patience is the only option. In Washington, officials are watching China's slow pace of purchases with growing concern. The administration's credibility is tied to the soybean deal, and there's pressure for China to honor its commitments. U.S. officials have reminded Beijing of the promised 12 million tons by year-end and 25 million tons annually. If China doesn't deliver, the U.S. is prepared to reinstate tariffs or other measures, risking a renewed trade war. The U.S. is focused on enforcing the deal, while China is focused on managing its domestic surplus. This divergence puts the relationship on edge, with the world watching for the next move. The coming months will test whether diplomacy or economics will prevail. For now, the humble soybean remains at the center of a global standoff. The dream of a U.S. soybean export boom to China is, for now, on hold. Despite political optimism, China's massive surplus and weak processor profits block the path to big purchases. Brazilian beans are cheaper, and even tariff-free U.S. supplies can't compete. State-owned firms may buy some U.S. beans for political reasons, but not enough to meet lofty targets. In commodity markets, economics trumps politics. Until China works through its surplus and processors recover, American farmers must temper expectations. The great soybean export boom isn't canceled, but it's delayed by a mountain of beans half a world away.